That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre joining us here to break down the moves today. Jared, break down that close.
It has been a nail-biter with the S&P 500 still settling behind me. I believe that's going to be good for a record high. I was looking for 6501.86, and it looks like it has beaten that. So good day for the S&P 500, up 84 basis points or 53 points. And let's just take a quick look at the chart here of the intraday price action. You can see mostly from the lower left to the upper right, just a little bit of red in the 10 a.m. hour, but that is a nice chart right there. Then you take a look at the NASDAQ, up even more, almost 1%, and very similar, dipped into the red just after 10 a.m., but finished on a high note right here. And then the Dow up 77 basis points, and very similar looking chart there. Also going to do one of our small cap indices. You can see that one soaring, they're surging 1.5%. That's the S&P 600. And let's move on to some sector action, where we see consumer discretionary. We've been talking about it leading all day, and it finished in the number one slot. That is XLY, up 1.83 points. And XLI, that is industrials, finished with over 1% of gains, and then so did financials. Communication services is fourth, but I believe financials and comm services both eked out record closes respectively, so you can add that to the list where we had the S&P 500, and all of those are outperforming. We only had one loser today. That was utilities, just slightly in the red for 13 basis points, or about 0.1%. And looking at the NASDAQ 100 XLY, that's consumer discretionary, guess what the biggest component is? It is Amazon. Amazon up 4.29% today, and there's another strong looking chart. Also, Tesla didn't hurt. That adds to the consumer discretionary total. That was up 1.3%. And taking a look at the Dow, we do have some outperformers to the upside and to the downside. Salesforce is kind of a sore spot in software, and software hasn't had the best time lately, and not today. That was down almost 5%, although off of the lows. Then, meanwhile, we have American Express, Goldman Sachs contributing to those gains, that record high that we saw in financials. Each of those up more than 2%. Disney, Caterpillar, and Travelers Group, each of those up more than 1%. And I can throw Home Depot, JP Morgan, and Walmart. So pretty broad-based bullishness here. And you can see that. I'm going to close on the leaders. We can see Home Builders was up 3%. That's XHB in the upper left, followed by a retail ETF, small oil, IPOs, regional banks, Mag 7, small caps, solar, all of those on the top row, turning in performances of more than 1%. And to the downside, only crypto was down more than 2%, although we also saw a weakness in China, software, emerging markets, and biotech. Back to you, Josh.
All right, thank you, Jared. Let's get some more on today's market action. Joining me now, got Matt Rowe, Managing Director of Solutions and Senior Portfolio Manager at Man Group. Matt, it's great to see you on set. So we were talking off camera, Matt, and I was saying how I got a lot of bulls come on the show. They sit in that very chair, Matt, you're in, and they say, listen, just keep it simple, Josh. They say, earnings are solid.
Yep.
Economy's hanging in there. Jay Powell's going to start cutting. You stay long in this market. But you say, I know, maybe there's some reasons for broad caution here. What would those reasons be, Matt?
Well, I think there's, number one, valuations, right? So when you're buying any risk asset, being long risk is a short volatility trade, right? You're betting on smooth sailing, you're betting on continued appreciation, you're betting on continued growth. When you have valuations where they are today, people start making relative value decisions about, am I really comfortable with the S&P at mid to high 20 PE ratio? Do we really think that we're in the type of environment where you're going to get the opportunities for companies to grow and sort of grow their earnings in that sense? That's probably the high level thing. But the next piece down from there is just economic friction. You have tariffs, you have inflation. Whether the two are connected is debatable. I would think that they are. But there's a lot of friction in the system right now, and the market's priced for perfection when you have what is a relatively risky world.
What do you say to those who on the valuation, and you know the argument I'm going to say, they're going to say, listen, valuation, it's not a market timing tool, and hey, things can stay pricey for a while.
Yeah, look, I think one of the top arguments for being long right now is a hope or a prediction that interest rates are going to drop. Because in classical economic terms, the present value of anything is equal to the future value if the discount rate is 0, right? So if you have higher rates, the present value drops to grow into a future benefit. Point being, I think a lot of the motivation or a lot of the rationale behind being long equities is a hope that we're going to go into a massive interest rate cutting cycle. It might be true on the front end, but what happens to the curve is really more determinant, because companies fund at the 5-year through 10-year. People borrow money to buy houses, 10 through 30-year. So the world in interest rates doesn't live and die on the front end of the curve. A lot of things are going to be determined by the shape of the curve.
Matt, what do you say to those strategies counter? We can talk about Fed, we can talk about rates.
Yeah.
Actually, what's more important, I've heard this argument, you probably heard this argument, is that mega AI trade and trend.
Yep.
And judging by what we just heard, that is intact. Look at the investing, look at the spending. That is what's more important to the market.
Yeah, I mean, look, if you are charged with and you're paid to take risk and invest money for people, you would be remiss to not be exposed to the potential explosive benefit of a theme like AI, right? Investors are routinely looking for opportunities that have multiplicative return potential, and that today is AI. So I wouldn't dismiss that at all, and I wouldn't say that we are at peak AI valuations. But I do think that where the economy is concerned, even investing in things like AI, I think we're likely to see some friction. I mean, we have JP Morgan's reporting earnings, I believe, October 14th coming up here. We're going to be getting a fresh round. Our view, my view, is that we're going to start to see the actual friction. I find it very interesting on a day like today, your colleague Jared, I believe, was pointing out that XLY was the #1 XL subgroup today, consumer discretionary. One of the ways that I would categorize the current rally is, and I don't mean this in a derogatory way, but a dash for trash, right? We see, from a factor perspective, we see high default risk equities rallying more than things that are more value oriented. People are reaching for risk right now. That tends to be a sign that there's a little bit of stretching in valuations. It's just one more sign that I see that people are kind of stretching for any form that they can get in what I view as the top end of a rally cycle.
Were you surprised that the economic data we got today showed again, certainly suggesting again, labor market, I don't want to overstate it, but again, cooling. Not crashing, but it's cooling. If you look at ADP, right?
Yeah.
Were you surprised that we got that, we shrugged and we just moved higher?
Yeah, this is one of those odd contrarian pieces of information where bad news can be good news, right? If you get bad economic data, it supports the case for lowering interest rates. And if, on a weighted basis, lower interest rates drive more in the equity risk premia world, then you can have these types of situations where, okay, you get a relatively soft economic data point, and it just increases the probability of Fed cuts, right? And then that net leads to a move higher. A lot of people are going to be focused on the jobs number tomorrow.
So I meant to your point then, tomorrow, the big jobs report on deck.
Jobs number.
Let's say, Matt, that comes in soft relative to expectations.
Yeah.
I'm curious, what do you think, would the market response be, okay, well, all right, the cuts, that's a lock, it's in.
Yeah, well, I think...
And conversely, I guess if it was stronger, would the market be like, whoa,
yes,
maybe it's not a lock?
Yeah, I think if we got a strong jobs number tomorrow, oddly, I think the equity market would have a bit of a fit. I mean, you look at what happened in rates today, it's been kind of all over the place as people come back from summer vacation and start paying attention to the markets again. We saw a significant sell-off in bonds, rates higher, bonds down. Today, kind of bounced back a little bit. I think what we would see if we got a strong number tomorrow is I think we would see a significant move in the yield curve, and I think equities would likely sell off a little bit because people are really positioned in betting on this aggressive rate cut. All that said, I do think that some of the pre-planned or priced-in action from the Fed is now on autopilot because there's some assumption that the new path is going to be driven with a little more connection to the political world and a little less independence. But that's a little bit of a third rail issue. So I'll.
Well, let me ask you about another interesting issue, and again, I want your take on this. You brought up tariffs.
Yeah.
And it's interesting to think about. Listen, the Trump tariffs now, the future of that is sort of in doubt.
Yeah.
The Supreme Court could rule on that. If the Supreme Court agreed and said, listen, yes, those are illegal, right? I'm curious how you think the markets could respond. Because I've seen some commentary where folks think, well, actually, if that happened, maybe the stock market thinks, okay, well, the margin pressure we were worried about, hey, that's gone. But maybe the bond market thinks, well, hold on a second, that tariff revenue we thought was coming in isn't.
Yeah.
What do you think?
Look, I think I don't think it'll be the end of the story either way.
Yeah.
I think that this is one avenue to apply tariffs using the route that the executive has used thus far. And I think that and I'm not a lawyer, but my read on it is that the application of the rule as it has been used is what was deemed to be invalid by the appeals court. So even if they uphold that with the Supreme Court, I don't think that the tariff discussion is over. I think this is such a core component of the current administration's policy of revenue generation that I don't think that this is done here.
Interesting.
So I think it's going to be a big deal one way or another.
Yep.
And I wouldn't want to speculate too much on where the Supreme Court lands on this, but I don't think the story's over, even if they uphold it.
Let's end here, Matt. Add it all up. Given the background, the environment we find ourselves in, for the viewers who are listening right now, how do investors want to be positioned here? What's your advice?
I would say know your risk and get paid for it, meaning don't let accidental expansion of your portfolio in value terms turn into a new comfortable position, right? If you've made money in the recent rally in the equity markets, and a lot of people have, I would look to get yourself back to the right type of exposure that you want. Doesn't mean panic and sell everything, but I do think it would be interesting and prudent for people to look at doing things like trimming down your small cap US equity exposure and reallocating some of that money to Europe, let's say. European index funds, things of that nature. Because there has been a lot of money made in the last few months coming off of April lows, and I think people just need to make sure to stay on top of it. And the valuations have really, really expanded, and you want to make sure to lock in some of that.
All right, Matt, thank you so much for your time today. Appreciate it.
Thanks for having me on.
That was great.
Yeah.
More Market Domination Overtime coming right up. Shares of Lululemon, they are sliding here after cutting its full year outlook. Let's get you those numbers. Q2 EPS, 310 versus 287. Q2 net revenue, 2.53 billion. The street was at 2.54 billion. Let's get to the outlook. Q3 EPS, 218 to 223. The street was at 290. And Q3 net revenue, they're calling for between 2.47 and 2.5 billion. She was at 2.56 billion. And for the year, they are now looking for EPS between 12.77 and 12.97. They had seen between 14.58 to 14.78. So they are cutting their outlook there. Some commentary from the CEO talking about disappointed with parts of product execution, disappointed with U.S. business results, is talking tariffs as well, and the impact there on gross profit. No surprise, after cutting the outlook like that, the stock here is down 12% very quickly in the after hours. For more on this, response to the print, the report, let's get to Zach Warring, CFRA analyst. The earnings are out, Zach. You cover the name. What do you make of the report?
Yeah, so it's a pretty bad quarter for the company, but I think, shares have mostly priced this in. Obviously, investors think not, but, shares have been trading poorly for 6 months now. And really valuation, even on their updated guidance, is really muted. I mean, they trade now currently at about 15 times the updated guidance, which is pretty much well below peers and well below its historic averages. So I think investors had this in the back of their mind that shares have been trading down, for the past 6 months. And it looks like, it's going to be about a 10 to 15% hit to gross margins, the tariffs. So pretty bad quarter overall. But there is some bright spots, international still growing well. I think that's a way they can start to insulate themselves from these tariffs. And we think that they can continue to grow internationally. They've got a long runway there.
Zach, you look at this stock, Zach, to your point, this stock had already been hammered. Heading into the print, it was down about 50% this year. Now we're down another 12, 13% here in the after hours. How do you reverse this, Zach? As a believer in the stock, what's the way to pull out of this for Lululemon?
Yeah, so they've got to continue to focus on international. That's huge for them, but they're really losing market share in the U.S. and you've seen that this quarter. The comparable sales were down, low single digits, which is pretty unheard of for the company, and they're not growing in North America at all. So. You really got to really focus on your product and innovation here to kind of meet the competition. And then they've got to really continue to execute internationally because, as they grow internationally, revenues will, become a larger percentage of total revenues, and it'll insulate them from the tariff rates. So that's what we think they need to do. We still like the company because valuation here is, pretty incredibly cheap, especially in terms of historical averages for the company.
Zach, how much of what we're seeing here and the pressure this business is clearly under, how much of this is due to an evolving competitive landscape?
I think a lot of it is, you can only blame, 50% on tariffs. They're clearly losing market share in the U.S. to these newer brands. It's just so easy for apparel brands now with social media marketing. You can target exactly which consumer you want, and you've seen that with these smaller brands really coming to light. And I think now, they're clearly losing market share in the U.S. And they need to work on their product and innovation to become, one of those bright brands that all U.S. consumers love.
You mentioned the tariffs, and clearly here, Zach, the tariff pressures continue for this company, and they're having a financial impact. What are the levers that Lululemon has been pulling to try to navigate that dynamic? In your opinion, have they been pulling the right levers?
Yeah, they have, and I think all apparel companies are, but they just have so much exposure to North America. I think 85% of their sales come from North America, which is the high end of most public companies nowadays. You have other companies that have less than 50% exposure to North America, and so they're doing what they can. They said in the statement released this afternoon that they've been working with suppliers to negotiate deals. I mean, it's the same thing you've heard from other apparel brands, except for the results this quarter were worse than the other apparel brands that have covered in recent weeks. So, we're going to have to wait and see here. But I think the big picture is they're losing market share in the U.S. and they're growing well internationally. But, they need to start to regain some market share. And the U.S. is the main ground for that.
Can I ask you, Zach, as they navigate tariffs, what have they been doing with pricing?
Yeah, I mean, you've seen some promotional activity. They don't have much typically, but they have, you've seen that promotional activity. But clearly they're not raising prices because it's showing up in their gross margin. And I just think they just can't right now because they're losing market share. So it's a tough, kind of a tough environment to be in. You're losing market share. If you try to raise price while you're losing market share, you're more than likely going to lose more market share. So, there's not much they can do until they get the right products in front of their consumers.
Can I ask you, Zach, do we have line of sight on who they're losing market share to exactly?
Yeah, they're losing to, some of these other brands that are new that, they kind of just popped up on Instagram and some of these other social media platforms. Vuori is one, it comes to top of mind. But there's quite a few, similar brands that carry that high-end consumer product. And they're really losing to those companies. It's not to the Nikes of the world, I don't think. We think it's more of the smaller brands because Lulu was a smaller brand at one time, and I think now they're more in Nike shoes where they're having to defend market share, and it's an interesting spot for the company to be in.
Zach, great to see you as always. Thank you. Time now for to watch Friday, September 5th. All eyes focusing, of course, on that jobs report for August, the report providing a key piece of economic data for the Fed ahead of its September FOMC meeting. Economists forecasting non-farm payrolls to rise by 75,000, a slight uptick from the 73,000 jobs added in July, signaling that hiring is still happening and companies are adding workers, but at a historically slower pace. Looking at unemployment, the unemployment rate is expected to edge up to 4.3% from 4.2%. Last month, remember, is a small move, but it means more cooling in the labor market and that it's a little harder to find a job than it was the month before. For the Fed, it suggests job conditions aren't quite as tight as before. And on the wage front, hourly wage forecasts call for 0.3% growth on a month-over-month basis. That's the same pace we saw for July, meaning that workers are still seeing paychecks increase, but the rate of growth isn't accelerating. Investors watching all the new data closely, which could set the tone for markets in September. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.